Hi everybody, I am G. NITHYA, Assistant Professor, Department of Commerce. Now we discuss the subject Advanced Corporate Accounting. In this subject, now we see the topic amalgamation, absorption, internal reconstruction, external reconstruction and types of amalgamation. Now we see one by one. Amalgamation is a combination of two or more companies into a new business entity by combining the assets and liabilities of both entities into one. Amalgamation can help to increase the cash resources, eliminating competition and save companies on taxes. Amalgamation generally take place between the larger and smaller entities where the larger one takes over smaller firms. Amalgamation is one of the tools that can help companies to avoid competition among them and add to the market offering. So the old companies are liquidated and the new company is formed. The next one is absorption. Absorption is the process under which an existing large company purchases the business of another smaller company or companies doing similar business. In other words, when an existing company takes over the business of one or more existing companies carrying similar business, so it is called as absorption. The company whose business is acquired or liquidated but no new company is formed. The next one is external reconstruction. The proverb old wine in a new bottle is 100% correct in the case of external reconstruction. Yes, when an existing company is liquidated and the same company is registered itself into a new one after the rearrangement of its financial position. There are two aspects of external reconstruction. One is winding up of an existing company and the other one is rearrangement of the company's financial position. Such arrangement shall be approved by its shareholders and creditors and it shall be sanctioned by the National Company Law Tribunal. The next one is internal reconstruction. Internal reconstruction is neither liquidated nor formations of a new company to take over any business. The existing company continues in its legal entity form and is only reorganized internally. So it is considered with the complete overhauling of the financial positions of the company. So that means reduction may be necessary for those companies whose financial position is very bad. Next we move on to types of amalgamation. There are two types of amalgamation. First one is amalgamation in the nature of merger and another one is amalgamation in the nature of purchase. According to Accounting Standard 14 on accounting for amalgamation, they should follow some certain procedure. No adjustments are required to be made in the book's value of assets and liabilities of the transferor company when they are incorporated in the financial statements of the transferee company. All the assets and liabilities of the transferor company become that of the transferee company. The business of the transferor company is intended to be carried on the amalgamation by the transferee company. Purchase consideration discharged only by the issue of equity shares in the transferee company except that cash may be paid in respect of any fractional shares. Next one is amalgamation in nature of purchase. This method is considered when the conditions for the amalgamation in the nature of merger not satisfied. So this method will be applicable. Consideration payable to the shareholders of selling company may be in the form of shares or cash or in any other agreed form. All assets and liabilities of the selling company may not be taken over. Less than 90% of selling company's shareholders may become shareholders in the purchasing company. If the purchase consideration exceeds the net assets value, then the excess amount is recorded as the goodwill, while if it is less than the net asset value, it is recorded as the capital reserve. Now we see the method of calculating purchase consideration. There are four methods for calculating purchase consideration. First one is net asset method, second one is net payment method, third one is lump sum method, and fourth one is intrinsic value method. Now we see one by one. First one is net asset method. It means the amount at which the transferor company has agreed to sell and the transferee company has agreed to take over a particular asset or liabilities. Otherwise, book value will be the agreed value. Fictitious assets are not taken over. Fictitious assets like preliminary expenses, underwriting commission, discount on issue of shares, discount on issue of debentures, and debit balance in profit and loss account. The next one is net payment method. Under this net payment method, the purchase consideration should be calculated by aggregating total payments made by the purchasing company. The next one is lump sum method. Under this method, the purchase consideration will be paid in lump sum as per the valuation of purchasing company valuation. The fourth method is intrinsic value method. It means intrinsic value measures the value of an investment based on its cash flows, where the market value tells you the price other people are willing to pay for an asset. Intrinsic value shows you the asset's value based on an analysis of its actual financial performance. The intrinsic value can be calculated as follows. First one is seller's assets value per share, that means equal to seller's net asset value divided by buyer's price per share. So we get seller's assets value per share. The intrinsic value ratio equal to seller's assets value per share divided by seller's total outstanding shares. Now we get intrinsic value ratio. Thank you.